What's going on, and welcome back to another episode of the Mortgage Mindset. I'm your host, Trevor Otsuka. I am a licensed mortgage advisor with Barrett Financial Group, and I lend on residential, commercial, and I also do private money lending for fix and flip and a couple of other things. So I'm going to dive right in here on a solo show. First thing, let's talk about interest rates. Okay. So today, the FOMC had a meeting and they made their second federal funds rate cut of the year, and they reduced the federal funds rate by a quarter of a point, which is 0.25%. So now that range for the federal funds rate is between 4.5 and 4.75, but that doesn't directly correlate to mortgage interest rates. So mortgage interest rates are still in the high six, low seven range for conventional, and then in the mid to low six range for FHA and VA. And the reason why is because the federal funds rate is really going to have an impact on your ability to borrow consumer money for things like HELOCs, like taking an auto loan, credit cards, those kinds of things. Uh, Mortgage interest rates are actually tied to the bond market, which is going to be mortgage backed securities, and then also treasury yields. So I'll show you a chart here on this or try to get it in here for you. But we will dive into exactly what's happened to interest rates ever since that federal funds rate. So we did have an improvement on the day. The interest rates did improve about 0.15% across the board, which is amazing. But we had a constant month, the last 30 days of deterioration in the market. And that's why you saw interest rates creep all the way back up to 7% after that first Fed rate cut happened in the middle of September. So conventional 30-year fixed is right now at 6.98% for national average. 15-year fixed is at a 6.45. 30-year jumbo is at 7.2. 30-year FHA is at 6.48, and then the 30-year VA is at 6.5. So when I'm looking at a chart for mortgage-backed securities, specifically the 5.5 coupon, when I look at the month, I mean, we've got a pretty long way to claw back to get back to the levels that we saw really at the end of September or even mid-September. So we're going to monitor this. We're going to see how things are going to progress moving forward. I would not expect interest rates to make a dramatic improvement as we close out this year. It'll probably stay pretty flat to close out 2024. So let's talk about econ data and what's coming up. We already talked about the FOMC Fed rate decision that happened today, but next week, the biggest market mover is going to be on Wednesday, which is core CPI month over month and then year over year economic data for the month of October. That'll be released at 5:30 in the morning. All the projections I'm looking at show that it's going to remain flat. It should be unchanged from the previous month. So we'll see what's going to happen there. Now, let's dive into this week's real estate news article headline. This is from The Real Deal Real Estate News. A lot of you are familiar with this. Great website, got a ton of content. This one says Trump, one of real estate's own, is heading back to the White House. Now what? What to expect? So I'm just going to summarize this one for you as opposed to reading the entire article. Again, I will include this link in the video description below. It'll also be listed in the link wherever you're listening. If it's on Apple Podcast or Spotify, it'll be in there as well. So one of the first things that he's looking to do is make potential changes to SALT deductions. So what does SALT mean? It's state and local tax deductions that allow consumers to itemize certain deductions that are related to real estate. So it says Trump has pledged to address the $10,000 SALT deduction cap, which has impacted homeowners in high tax states like New York and California. Restoring full deductions could increase purchasing power and home values in these areas, making it a significant topic for real estate professionals and buyers. The second thing that he's looking to do is to preserve 1031 exchanges. Now, because I do a lot of investor loans, I also do commercial lending. This is a huge, huge thing for anybody that is investing in additional investment properties, anything that's rentals. If you're going into commercial space, if you're in multifamily, if you have retail strips that have multiple tenants, those property values are going to increase over time. And when you sell them, normally you would have to pay capital gains tax on any of that property appreciation that's realized at the time of the sale. So the only way to get around that is through the IRS tax code, that is the 1031 code, and it allows you to defer those capital gain taxes until later on down the road because you're basically going to replace the relinquished property with a like kind exchange replacement property, and you'll be able to roll that equity right into the new property. Once it's in place and you have the replacement property in place and the 1031 exchange has been completed, you could then access the equity in a property by performing a cash out refinance, and cash out refinances are tax free. You don't have to pay taxes on those. So that is really the major play that investors use in order to not have to pay capital gains tax on the equity that is grown in their investment properties. So if you guys are getting into the investment space, you haven't learned about this before, I highly encourage you to go on YouTube and do a little digging into 1031 exchanges. You can always reach out to me as well, and I can kind of walk you through it. So here's what it says. It says, the real estate industry is optimistic that a Trump administration would protect 1031 exchanges, which allow investors to defer capital gains taxes on property sales by reinvesting in similar properties. For investors and developers, this is a crucial tax advantage, and preserving it could stimulate more investment in commercial and residential real estate. The third thing that he's looking to do is to support opportunity zones and development friendly policies. Trump's policies aim to streamline regulations, especially for developers, and support opportunity zones to spur investment in underserved areas. For mortgage originators, these changes could increase demand for financing in areas marked as opportunity zones, offering both investors and communities more growth potential. So, what do you guys think? I'd love to hear your comments on this. You could leave a comment below. You could message me on Instagram, on Facebook, on LinkedIn, and let me know your thoughts. I'm going to link this article below so that you can read this. What do you think? Do you think that the next administration coming in, do you think it's going to be beneficial to the housing market? If you're a real estate agent, do you think that we're going to see the housing market improve, that we'll see more inventory coming in, that we're going to see rates start to decline? And then we're going to get increased buyer demand, people that are frozen in place that took ultra low rates on refinances during the COVID pandemic. Do we think that those properties will start coming back into market because rates will be lower and they have a need to upgrade to a new house, or maybe they need to downsize? So it's going to be interesting to see. But that's going to do it for this week's episode. I appreciate you guys. I love you. I will see you next week.